una depresión económica. Saludamos a Lance Roberts, es Chief Strategist in RIA Advisors. Lance, thank you so much for having us a few minutes.
Absolutely.
Lance, different market analysis firms are warning U.S. recession risk now higher and more front-loaded. Which is your vision? Do you see a depression in the U.S. economy or a recession?
Probably more of a recession. Look, all that's happening now is that we had a lot of liquidity put into the U.S. market, by both the government and the Federal Reserve. And then, of course, because the U.S. economy is so large, it's $20 trillion globally, that's spread over into a lot of other countries as well, Spain, Europe, and in general. So we're seeing this kind of lift of inflationary pressures because of all this money that was injected in the system. So now that's coming back out again. So we'll have a recession and an economic slowdown, but the risk here to a bigger recession or potentially a depression would be the Federal Reserve going too far in the United States to hike interest rates to try to bring down inflation, and they wind up causing a credit event. Now, we don't see that happening right now, but it is a risk.
And considering the current market scenario with these high inflationary pressures that you mentioned, which investment opportunities do you see? How should we recalibrate our portfolio?
Well, one thing we want to do right now is hold a little bit more cash because there is a lot of uncertainty in the markets globally right now. The question is how far will the Fed hike interest rates? As they hike interest rates to quell inflation, that means inflation comes down, economic growth slows. So over the last year, we've all been long, a lot of commodity trades, energy has done very well. So now I want to come back more towards the defensive side of investing. Think things that are going to survive a recession. Companies that are more staple oriented, technology should do a little bit better here. They've been under a lot of pressure, but then also think about fixed income. Fixed income tends to do very well as a shelter against economic uncertainty.
And which sectors, if we talk about equity markets, could take advantage if we see an economy recovery by the end of this year?
Well, coming out of a recession and going into a recovery, you'll want to definitely look at things like staples, consumer discretionary, companies like Amazon here in the United States. They've been under a lot of pressure. Also think about technology, growth-oriented companies that have the ability to generate high levels of revenue in a recovering economy. Also things like financials should also do very well coming out of a recession as interest rates start to settle down, and that creates better income and activity in the economy.
Which is the key message to maintain our capital, our money? Is diversification the best way to achieve that, or maintain liquidity?
More liquidity right now. Holding some extra cash at this moment, being a little bit more defensive in your portfolio allocation, less equity exposure, at least here for the next couple of months as we get through summer. We're still going to have a lot of rallies in the market like we're having now, these short-term kind of bear market rallies, but those are going to resolve themselves lower as we start to bring down earnings. As we have slower economic growth and lower rates of inflation, earnings have to come down, and those estimates haven't come down yet. So there's going to be more downward pressure on equities over the next few months.
As an expert, Lance, in private banking, are we witnessing the end of the CCAFs with the entry of new requirements?
Maybe, the things are is that markets are very, they adopt very quickly, but we are starting to see a lot of changes here that is going to impact money flows here over the next few years. Changes from the SEC in terms of payment for order flow and a variety of other areas on the trading side, but on the investment banking side as well. There's going to be a lot more concern about, putting capital to work in companies that aren't necessarily, strong revenue growers. So we're going to see a bit more of a contraction potentially in investment banking over the next year or so.
This week we have a lot of references. We have the autumn reunion in NATO reunion in Madrid. We have also a reunion between central bankers in Sintra. The ECB will be there, of course, but also Andy Whaley and Jerome Powell. But if we talk about macroeconomics, we have two references really important. US GDP on one hand and Eurozone CPI on the other hand. What can we expect? How should investors deal with this data?
Well, what you're going to see here over the next few quarters, you're going to see weaker economic growth here in the U.S. As you saw inflation come up in the Eurozone, because we had a lot of inflationary growth here because of all that liquidity, that's going to start to be quelled in actually both the Eurozone as well as the U.S. So we're going to start to see slower rates of economic growth. We will have disinflationary pressures by the end of this year. If central banks go far, and this includes the ECB as well as the Federal Reserve in the United States, if central banks hike rates too much trying to combat this inflation, that's going to lead to a more deflationary environment rather than just disinflation. So again, the thing you really want to keep a watch on right now is how far and how fast central banks are trying to act to quell inflation, and what the flow through is going to be into economic growth, which will be much weaker as we head towards the end of the year. And this is one of the reasons I'm saying hold more liquidity right now, hold some extra cash, because we have a lot of uncertainty right now. Central banks aren't coming to the rescue of markets in the economy. They're trying to fight inflation first.
And one last question, considering the plans of G7 to announce a ban on Russian gold imports, how do you see the evolution of prices in gold?
Well, the problem is that gold is a function of real interest rates. So that's inflation adjusted by the inflation rate. So as we take a look at how gold has performed this year, the ban on Russian gold will certainly help bring and at least support the price of gold here near term. But as an investor and as investment managers ourselves, we have a long position in gold for two reasons. One, a lack of liquidity in that market, which can provide for some very outsized moves. Gold tends to perform much better as we get into a more fearful environment. So if we get to the point that central banks have gone too far in terms of trying to hike rates and quell inflation, that's going to provide a very strong bid for gold. And because of the ban against Russian gold, that's going to provide for less access to gold, leading to better price performance for gold on a supply-demand basis.
Thank you for this analysis, Lance Roberts from RIA Advisors. It's been a pleasure.
Thank you so much. I appreciate it.
Nos quedamos, por tanto, con este análisis por parte de Lance Roberts. Él